please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. As promised, Mahesh Nandurkar, India strategist at CLSA, is with us. Mahesh, good morning. Good having you on the show. You have been slightly, negative on the market for some time now. You reckon the market may have made a bit of a top for the year, considering the kind of macro headwinds that we have at this point in time?
Yeah, we think so. So we are right now, the Nifty is just about 2% or so below the peak that we saw in the month of Jan. And I think, given where the macro has been heading, and also given the fact that the bottom of micro has not really improved as much as what the initial expectations were. I mean, while we talk about the earnings trend improving, but remember that the earnings revisions are still happening on the downside. So yes, I would be willing to take my money off the table at the current levels.
Oh, take money off the table. Good morning, Mahesh. Always good to have you with us. There is nevertheless a global growth story playing out. Even the higher yields and higher commodity prices are because there is aggregate demand increasing. So do you think that provides a bottom for our markets? Can't fall below a level?
True, the coordinated global growth is playing out in the US. We've seen that happening to a certain extent in Europe as well. But remember, also with the coordinated global growth improving, also comes the possible money supply reducing a little bit as well. So as we have seen, the US Treasury yields are now a little bit higher than 3% mark. And if they move further from here on, obviously the attractiveness of the other emerging market assets like the Indian currency, etc., will reduce. Also, there is this possibility that if the growth picks up and sort of continues to sort of show strong momentum in Europe, there is a good chance that even the ECB will tone down its QE program. So while the global growth might be improving, but we need to be aware of the possible side effects as well, that the global liquidity conditions, the money flow will not remain as attractive as it has been over the last 3-4 years.
So in that context, Mahesh, good morning, this is Sonia here. Do you get a sense that domestic flows have peaked out? I mean, even in the month of April, we saw about $2.2 billion of flows, equity inflows that is, which is much less than the average over the last 6 months. You think flows have peaked out, especially into markets like India?
Yes, so the thing is that as compared to the previous 6-8 months, we were seeing almost $3 to $4 billion a month. The month of April was weak. On an absolute basis, I would still say that a number of $2 billion to $2.2 billion number is not bad. But I think what we'll have to see that number in the context of is the possible equity supply, the corporate paper supply. Right? In the last financial year FY18, we saw about $27 billion worth of equity paper supply. And that was very well absorbed by the market because the domestic flow was very strong at $33 billion. Now going into FY19, our estimate is that the equity supply pipeline is looking as big as it was last year. So that $2.2 billion kind of a number that we saw in the month of April may not be sufficient if the equity supply continues to be at that level. But on an absolute basis, that number looks okay. But yeah, I think what we will also need to kind of figure out is, if there is sort of any headwind coming from either by way of the long-term capital gains taxes, which have already started to play out. Is there, some money moving into physical assets? Because there are some anecdotal evidence that the property markets are showing signs of bottoming out. So those are the factors that we'll need to keep in mind.
Okay, Mahesh, Karnataka results came yesterday, of course. Bit of a cliffhanger. The market got almost what it wanted, but the BJP was elusive of that victory, of course. But your thoughts on, how big a risk politics is this year, considering the fact that the BJP is the single largest party, and a lot of that happened after Prime Minister Modi's campaign. Does that assuage some concerns about 2019?
Yeah, so the fact that BJP emerged as the single largest party in Karnataka state clearly reverses some bit of negativity that has been setting in for the last few months. So to that extent, it'll help boost the investor sentiments. But I think key was really to see who really ends up forming the government in Karnataka state. I think a lot of global investors are looking at that. Because it not only signals whether a party or the leader is popular or not, and that we've already seen. But also whether they are able to pull in the allies, because that is also going to be an important factor going into 2019 elections. We have seen some amount of turnover in the allies. I mean, one party has left, one other party is threatening to quit, but yes, there could be more new parties joining in as well. So I think the investors will also be focusing on the ability to attract some of the allies. So that's something will be something that will be on the top of the minds for investors. But I think now the next political event is at least 7-8 months away. And so to that extent, in the meanwhile, the market focus will come back on fundamentals.
Okay. Yeah, but my plea still is that the fundamentals look good. Global growth is good. A lot of micro say FMCG growth numbers, rural growth numbers are looking good. So what are you working with in terms of earnings, and what kind of valuations will be justified for you in the market?
See, I would have a slightly different view. I would say that the fundamentals of the market are not looking really that great, especially on the macro side, whether it is the bond yields, inflation outlook, currency outlook, etc. So I think macro front is clearly much weaker today as compared to what it was, let's say, 12 months ago, 8 months ago, something like that. Even from the bottom-up side, as I mentioned, while the absolute level earnings growth seems to be showing signs of improvement, but that's there in the numbers, that's there in the expectations already. And at the margin, what we are seeing is still small earnings downgrades. So I think we still need to sort of keep that in mind. And the thing is, while in the last 1.5 months we've seen the market rallying, just to repeat my point, that was because the domestic inflows were still quite strong, and there was no equity paper supply. So I think watch when happens, what happens when the equity paper supply begins to hit the market.
Okay, so give and take everything, Mahesh, given that macros are weak, there will be a lot of equity supply in the near term. What do you think the fair value of this market is, and how much of a downside can we estimate over the next 1 year?
So, we are working, with an assumption that over the remaining period of 2018, at best, we will, get market returns maybe in low single digits. That's the sort of, more optimistic case that we're looking at. So in comparison to that, I would say that, some of the, sort of, corporate bond fund or, a low tenor, kind of a debt sort of exposure might actually deliver better returns than equity over the next 6 to 8 months is what my view is.
For hardcore equity investors, Mahesh, is there a safe haven buying, perhaps some consumption names, IT names, anything, or this is not a year of equities, you believe?
No, so on the on the equity side, there are clearly certain segments that will do much better than the broader market. My sense is that over the next 12 months, we will see consumption, stocks, consumption stories playing out well, because clearly over the next 12 months, my sense is that both the central government and many other state governments as well will follow a pro-consumption policy, a pro-rural, a pro-poor kind of a policy. And in that context, a whole host of consumer names, should do well. Obviously, the headwind for the consumer staple sector, which would obviously be, the best way to play the story, is the valuation. That many stocks are, in the range of 45 to even 55 times, P multiple. But if we do some analysis, it's not very difficult to find some of the relatively cheaper names, which are trading at about 30 times, 35 times, which are some of the plays on consumer discretionary side, on the household durable side, even the tobacco sector. I think some of those names, I would say is a good way to play the expected sort of improvement in the consumption theme. That's one. I would also highlight that we continue to stay quite bullish on the housing story as well. So we actually like the whole chain, starting from housing finance companies, the property developers themselves. I think will be a good way to play the equity markets over the next 12 months. In fact, I would say the property story will be a multi-year story. It should play out over the next even 3 to 5 years. So it's a long-term bet as well.
Well, one hopes that plays. But what would your reddest flags be? Where can things fall with a thud? Where are they so terribly overvalued?
Well, I don't think there is in one specific pocket which is has like a very high risk segment, but clearly where we have seen some of the sort of interest rate sensitivities, we have seen the bank lending rates going up by about 20 bips or so far. Maybe they go up by another 20-25 bips or so, maybe a little bit more. So some of the names which are highly geared towards like more leverage, higher debt, where the interest cost can make a difference, could be more vulnerable. We see that the competitive intensity in the telecom space is also not over as yet. So that's also a space that I would maintain my underweight on. So yeah, so there will be some pockets, I guess, where one needs to be cautious.
Okay, we look forward to speaking with you more often, Mahesh. Thanks for stopping by and speaking to CNBC TV18. That's a somber voice coming in from CLSA. They say, at best, expect a single-digit return this year in the markets. We'll take a break. Up next, we'll dissect the impact of the SEBI circular barring fund managers of Indian origin from managing FPI money. That's actually caused a lot of furor over the FPI market.
Now taking out time to analyze a SEBI circular which came last month. Although it's a month old, it's something the market has not concentrated on because of earnings and other macro concerns. But what this circular did is it has barred fund managers of Indian origin from managing foreign portfolio money, and it is applicable to fund managers of Indian origin who have more than 15% economic interest in the fund or in the AMC. Now, this is part of SEBI's and the government's prevention of money laundering activities. Obviously, the underlying belief is that any fund managed by Indians abroad and where the Indian is owning more than 15% of the fund or the AMC would be, probably a money laundering candidate. Looks like a very harsh kind of measure. But let's ask people who could be affected. Nandita Parkar, managing partner of Karma Capital, joins in, as does Sudhir Kapadia, national tax leader of EY. Nandita, first thoughts, you would be impacted?
All of us are impacted.
Okay.
So, we launched an India-focused fund in 2004. We were the first ones to come up with an India-dedicated fund. In those days, there was no investment case for India. So we were the first ambassadors of the India investment case. And after me, a whole host of people have been launching India-dedicated funds. So there are about more than 75 of them. And they're all affected.
Okay,
yeah.
so
it's unheard of.
No, I agree with you. Have you spoken to SEBI, and are they able to see your side of the story?
So we have spoken, and my guess is that the diktat for this is coming from the ministry and from some silo within the ministry. I also think that this kind of gunshot policy making is very counterproductive. It's gone on for long enough. And I think that what happens in developed countries is when new policies or new regulations are being formulated, usually the government will invite senior members of industry and stakeholders to come and give their comments. There might be a draft paper that would be put out, and people would be collaborating and looking at the various pros and cons and the consequences intended and unintended of such regulation. Whereas in India, this has not been happening. And I think it's time for sort of a very proper look at how policies should be formulated, and so that this kind of discrimination, which is so blatant and awful, should not happen.
So what kind of money are we looking at here? How much would be at risk if these trades have to be, say, ended by October?
So we're estimating something between $15 to $20 billion.
Oh, that's quite a bit of money. Let's get Sudhir Kapadia into this discussion as well. Sudhir, what is your own understanding of this circular? I mean, it seems a bit bizarre now as to how the entire community, could sort of suffer, and we're looking at big money, $15, $20 billion. What's your own understanding, and you think it could come through?
So I think 2 points. One is I agree with Nandita that I don't see the logic in coming out with a circular without having consultations with stakeholders and at least getting 360 degrees views from everyone. I think that should be a practice which should be followed in future. I think the second point, looking at from a regulator's perspective world over, we know that there is an intent to get more information, more data, and use all tools available to protect the base, anti-money laundering objective, etc. But what I fail to understand is that why do you want to prohibit a particular class, that too of Indian origin, from having control beyond a particular limit? If you look at the FATCA example, would you not rather have the data with you? You say, okay, you are investing more than this threshold, or you are controlling more than this threshold. We want the information. You are talking about technology, you're talking about data mining in various spheres of government policy. Use that data and track wherever you think there is potential wrongdoing. I think that would be a more mature way of handling it, and this unintended consequence, which seems to be unintended, of actually prohibiting people of Indian origin from money management, which is just bizarre. And I'll just make one quick additional point. As we know, 9A in the Income Tax Act came in for a very laudable objective of encouraging money management firms to be set up in India. Even if the offshore fund is outside of India, why not have the money management firms in India? Now think about that. You are encouraging that under 9A of the Income Tax Act. And here you are saying that, by the way, when you appoint the money manager, you cannot appoint a person of Indian origin.
Yeah.
No, so there's clearly, no, it's not even,
Mr. Kapadia, is there some ambiguity still regarding high-risk jurisdictions? Is that even defined?
Yes, I think that's a great point as well. You see, I think on high-risk jurisdictions, frankly, there is so much, interpretation here in various laws that it just increases the uncertainty and subjectivity. One suggestion could be the Financial Action Task Force has actually has a well-defined list. It's a compact list after looking at, the global jurisdictions. India should adopt that, these rules or these kind of notifications from SEBI, if at least they look at that list or link it to that list, and global custodians understand. Otherwise, saying that it is high risk by itself, as I said, is only a subjective interpretation. There is another way of looking at it. Link it to the Income Tax Act, which talks about non-cooperative jurisdictions. The only one which came out was Cyprus, which has also been withdrawn because they complied with. But at least in future, if there are any non-cooperative jurisdictions, then those can be considered high risk. I don't see why, or let me put it this way, it is better to define it. And you can take your choice, define it as it is done in an overseas body, or define it as it is done in a local legislation, as I said, like the Income Tax Act.
Okay. Well, we've actually run out of time, so let me just try and squeeze in one last question. Nandita, you were telling us you've made representations to SEBI and the FinMin. What have you got out of that? Have they stonewalled you completely, or is there some sort of negotiations there? And also, even if the Finance Ministry tries to enforce this, do you see a lot of funds altering their structures or, changing their model to get past it?
So let me answer the first question. We're now reaching out to the Finance Ministry. As you are aware, the Finance Minister has been unwell, and a new man is at the helm. So we're very hopeful that we'll be able to make a representation to the ministry and let them see the consequences of this are pretty dire.
Okay.
It also sends a very bad message to global investors of what India is trying to do here. And I think we need, it's high time we need a little bit more consistency in policy towards foreign investors.
Fair point. Out of time, Nandita, and I do hope things will alter.